To understand cost of carry, we have to understand spot price and future price. Spot price is the current market price or today's price, and the future price depicts price related to a future date. Cost of carry is the relationship between spot price and future price. This is ideally the cost of carrying the underlying from spot price to the future date. Commodity cost of carry can include cost of funding and storage cost of the commodity. For equity, it is the finance cost to purchase the instrument minus the dividend received of the instrument. Margin costs are created to safeguard the interest of the counterparties at the time of settlement. Brokers have to deposit initial margin on the exchange to execute trade for their clients. Buyers and sellers who become the clients of the broker have to deposit initial margin for carrying on any trade. Initial margin is the amount buyer or seller has to deposit in margin account at the time of entering into a futures contract. This has to be paid to the broker of the exchange with whom the buyer or seller get into a contract. The percentage of the initial margin is dependent on the volatility of the underlying. Exchange charges margin from broker and brokers in turn charge margin from their customers. In this example, calculate initial margin where initial margin percentage is 10% of the contract value. Step 1. Calculate contract value, which is 7,96,083 rupees and 75 paisa. Initial margin at 10% will be rupees 79,608. Client needs to deposit 79,608 rupees as margin to enter into the contract. Marking to market is a process where profit and loss of a trade is calculated on a daily basis. Exchange collects MTM margins from loss-making participants and credits gains to traders' account on a daily basis. In case of a debit, if the margin account does not have sufficient balance, the participant has to bring in additional funds till next day morning. First step for calculation of MTM is to calculate the gain loss position at the end of the trading day. In this example, closing is rupees 10,714 rupees and 45 paisa, which is higher than the previous day closing. The gain is of 100 points. Step 2. Net gain in position is rupees 100 into lot size, which equals rupees 7,500. The gain of 7,500 will be credited to the margin account of the participant. Next day position will start from 10,714 rupees and 45 paisa. Next day MTM will be calculated on the basis of today's closing price. That is, today's closing figure becomes tomorrow's opening figure. In this example, calculate the MTM for the next 3 days as given in the slide. Do your working, and in the next slide we will verify your answers. Check your answers with the MTM value given in the slide. Open interest represents the total number of outstanding or unsettled contracts related to the underlying at a specific date. For each buyer of a futures contract, there must be a seller. From the time the buyer or seller opens the contract until the counterparty closes it, that contract is considered open. For calculation of open interest, only one side or one leg of the contract is considered. It is an important indicator for an investor. If open interest is increasing, then it is an indication that more participants are watching the market closely and more money can flow in. A decreasing trend of open interest indicates money flowing out of the market. It should not be confused with trading volume. Trading volume refers to total buy and sell activity, whereas open interest represents only the unsettled contracts of the underlying. Price band is defined in the contract specifications. It is either defined in percentage or in absolute terms. An open position is any trade entered that is yet to be closed with an opposite trade. An open position can exist following a buy, a long position, or a sell, or a short position. In any case, the position remains open until an opposing trade takes place. In this example, on day 1, investor buys 4 futures contracts and the open position at the end of day 1 is 4 long. On day 2, another 2 futures contracts are purchased. End of day, open position is 6. On the next day, 3 futures contracts with the same expiry date are sold off. At the end of 3rd day, total open position is 3 long, as the other 3 positions have been squared off. For MTM calculations, open positions at the end of each day will be considered. Square off. Square off is taking a reverse position for a position already taken. Example, if anyone has taken a long position, to square it off, a short position with the same expiry date is taken. Rollover. It means closing out open position of the contracts at last trading day of the month and again taking the actual position on the opening day of the next month.